Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance. And folks, this filing is a doozy, packed with some eye-opening details about Dynamix Corporation III and their plans, or lack thereof, for a business combination. Get ready because we're about to decode this S-1 filing and see what is really going on behind the scenes. Before we dive in, if you are all about getting the real scoop from these DentSec filings, make sure you hit that subscribe button. And hey, we've built an amazing community on Discord where we break down these reports together. You'll find the link in the description below, so come join the conversation. Alright, let's cut through the noise. What we're looking at here is an amendment to a registration statement filed back in October of 2025. It is for something called Dynamix Corporation III, and it is essentially their roadmap for going public. Think of it as a company saying, hey, we want to sell shares, and here is why you should trust us. But here is the kicker with these types of companies. They reknown as SPACs, or Special Purpose Acquisition Companies. They don't actually make anything or do anything. Their sole purpose is to find another company to buy. It's a bit like a company with a blank check looking for a business to acquire. So Dynamix Corporation III isn't making widgets or software. It is a blank check company formed in the Cayman Islands, meaning it is here to find a real business to buy, merge with, or acquire. The folks behind it haven't even picked their target yet. They're upfront about it, saying they have not selected any business combination target. This is pretty standard for SPACs, but it's crucial to remember they are essentially a shell company at this stage, waiting for the right opportunity to emerge. Now, let's talk about what they're reselling to investors. They're re-offering units at $10 each. Each unit is made up of one Class A ordinary share and half of a warrant. A warrant is basically an option to buy a share later at a set price. Here, each whole warrant, meaning two halves, lets you buy one share for $11.5. They're redoing this to raise a substantial amount of money, $175 million before accounting for fees. It sounds like a lot, but remember, this money is going into a trust account, intended for the eventual business acquisition, not for the company to spend freely right away. Here is a really important detail for any investor. You have the right to get your money back. If you buy shares in this offering, by the time they find a business to acquire, you can choose to redeem your shares. They promise to give you back pretty much the original amount you paid, plus any interest earned in the trust account. This is a key protection for investors in SPACs, giving you an out if you don't like the deal they eventually strike. They're re-aiming for NASDAQ with plans to trade under symbols like DNMXU for the units, DNMX for the shares, and DNMXW for the warrants. This is normal for a company going public. They expect the shares and warrants to start trading separately about 8 weeks after the offering, unless the underwriters decide to allow it sooner. Now, about the company itself, they're calling themselves an emerging growth company and a smaller reporting company. This means they get some breaks on reporting rules, like not needing to follow all the strict auditor rules for financial reporting right away. Think of it as a temporary pass on some of the tougher regulations for newer public companies. This can save them money, but it also means investors might not get as much detailed financial information as they would from a more established company. Let's focus on the money. A huge chunk of the proceeds, $175 million, will go straight into a trust account. This is the money they are saving to buy another company. It is kept separate and safe until they find a business to acquire or until they have to return it to investors, if they don't find a deal. This trust account is a cornerstone of SPACs, ensuring investors' money is fenced for its intended purpose. Here is where it gets interesting and a bit concerning for investors. The company S-sponsor, which is Dynamix Corp Holdings III, is holding around 6.7 million Class B ordinary shares. They bought these for a ridiculously low price, just $25,000 in total. That works out to about $0.004 per S-share. Now, why is this a big deal? Because when the company eventually merges with another business, these sponsor shares convert into Class A shares, and since they got them for practically nothing, they stand to make a massive profit, even if your investment does do so well. This can create a conflict of interest. The sponsor might be motivated to make any deal happen, even a bad one, just to secure their profit. On top of those cheaply acquired sponsor shares, the sponsor and the underwriters are also buying a lot of private placement warrants at $1 each. These are essentially shares they can acquire later at a set price. This gives them another stake in the company and another way to profit, again at a price that is much lower than what you, the public investor, are paying for your units. This structure is very common in SPACs, but it is important for investors to understand this inherent dilution and the potential conflict of interest it creates. Now, let's talk about timing. SPACs like Dynamix have a deadline. They have 2 years from the moment they go public to find a company and complete their acquisition. If they don't find a deal within that time, they have to return the money in the trust account to the investors and dissolve. This deadline creates pressure to find a deal quickly, which again could lead to less than ideal choices. Looking at the dilution aspect, which is absolutely massive here, the document explicitly states that because the sponsor got their shares for almost nothing, public shareholders will face immediate and substantial dilution. What does that really mean for you? It means that your ownership stake and the value of your shares is immediately worth less because of the sponsor's cheap shares and warrants. The charts here show that if you buy in at $10, your book value per S-share could drop to as low as $0.22 in a maximum redemption scenario. That's a nearly 98% dilution. It highlights how the initial structure disproportionately benefits the insiders. This is a recurring theme, conflicts of interest. Key people in the company, from the sponsor to the management team and directors, have stakes in those cheap founder shares and private placement warrants, meaning they stand to make a lot of money if a deal goes through, regardless of how well the acquired company performs. The filing warns repeatedly about these potential conflicts, stating they may have a conflict of interest in determining whether a particular target business is an appropriate business. This is a huge red flag for any potential investor. It means decisions might not always be in the best interest of public shareholders. And it gets even more complex. Many of the key people here are also involved with other companies, including another SPAC called Dynamix the Suit. This means they could have competing loyalties. If a good business opportunity pops up, they might have to decide which company gets it first. And that decision might not always favor Dynamix Corporation III. This adds another layer of potential conflict and distraction. Despite all these risks and conflicts, the company does try to sell itself by highlighting its management team's experience. They claim the team has a great track record in identifying and building businesses, especially in energy and power. They believe their expertise and networks will help them find valuable companies and increase shareholder value. It is the classic SPAC pitch. Trust our experienced team to find you a great deal. Their strategy focuses on finding businesses in the energy, power, and digital infrastructure sectors. They're looking for companies that can handle the growing demand for energy, possibly by using cleaner methods or supporting the infrastructure needed for things like AI data centers. They see a lot of opportunity here, especially as the world shifts towards a more sustainable energy future. They point to the massive global investment in the energy transition, showing a significant market trend they want to capitalize on. They're specifically interested in areas like fuel handling, advanced nuclear tech, carbon management, and water systems. Basically the essential but often overlooked parts of making the new energy system work. They also highlight the power sector's transformation driven by increased demand from things like onshoring manufacturing and the massive power needs of AI data centers. This, they say, creates opportunities in generation, distribution, and grid resilience. They even quote a Goldman Sachs report about data centers doubling power demand by 2030. This market focus could be interesting if they can find the right company. In the oil and gas sector specifically, they're looking at exploration, midstream, and oilfield services. They believe there is a chance to buy established assets at good prices because of factors like aging private equity funds needing to exit and limited capital access for oil and gas companies. They think current commodity price volatility has depressed asset values, which they see as an opportunity. And finally, they're looking at digital assets and related infrastructure. They see blockchain and tokenization intersecting with energy markets and real estate. They're interested in platforms that handle digital asset infrastructure, custody, compliance, and even decentralized compute networks. This is a forward-looking bet on the intersection of technology and physical infrastructure. Now, let's talk about the elephants in the room, the risks. One major risk they acknowledge is the sheer competition. There are a lot of SPACs out there looking for deals, and attractive targets are becoming harder to find. Plus, some companies might be turned off by the idea of merging with a SPAC, thanks to some negative press surrounding these deals. This competition could drive up prices for acquisition targets, making it harder for Dynamix to find a good deal. Remember those cheap founder shares held by the sponsor? Well, they get voting rights. This means they could potentially push through a deal that public shareholders don't fully support, especially since the sponsor has agreed to vote their shares in favor of a business combination. This is another point where investor interests might not align perfectly with the sponsors. Circling back to dilution, the filing is very clear. Public shareholders will incur an immediate and substantial dilution. This is the price you pay for investing in a SPAC structured this way. Your stake in the company's assets is immediately less valuable due to the insider's favorable terms. The tables here visualize this starkly, showing how your initial investment value can be significantly less than the price you paid, depending on how many shareholders choose to redeem their shares. And finally, a tidbit on legal matters. Because this company is incorporated in the Cayman Islands, many legal disputes will be handled in Cayman Islands courts. The filing makes it clear that enforcing judgments from US courts might be difficult, and Cayman Islands law might offer less protection to shareholders compared to US laws. This is a common feature for companies incorporated offshore and is worth noting for international investors. So, what's the bottom line on Dynamix Corporation III? They re-SPAC with a broad focus on energy and its related infrastructure, including digital assets. The management team has experience, which is a positive. However, the filing is very upfront about significant dilution for public investors due to the sponsor low cost equity and warrants. There are also numerous conflicts of interest highlighted, stemming from the sponsor and management as multiple affiliations and their substantial stake obtained at a nominal price. The pressure of the 2-year deadline to find a deal is always a concern with SPACs, and the potential for acquiring a company with unclear financials or management talent remains a significant risk. Ultimately, investing in Dynamix Corporation III, like any SPAC, is a bet on the management team. Its ability to find and execute a successful business combination against stiff competition, and within a tight deadline, all while navigating potential conflicts of interest that heavily favor the insiders. The dilution numbers alone are a stark warning that you are entering this deal at a disadvantage. Alright, that is our deep dive into Dynamix Corporation III, SS-1 filing. What are your thoughts on this SPAC structure and its focus areas? Do you think the management team experience outweighs the inherent conflicts and dilution? Let me know your take in the comments below, and if you found this breakdown insightful, please hit that like button, it really helps the channel. Subscribe for more deep dives into the business world, and don't forget to join our Discord community, linked in the description to keep the conversation going. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.